Before you leave your super to your children, there's something most Australians don't realise can significantly reduce what they actually receive. And by the time it matters, it's often too late to do anything about. So let me walk you through how super is taxed when it passes to your kids, and the strategy that can reduce that bill while you still have the time. A lot of people assume that once they pass away, their super simply goes to their children tax-free. But for many Australians, that's not actually how it works. Because while super can be very tax effective during your lifetime, when it passes to adult children, there can be a significant tax bill attached to it. And this is something I see quite a lot in my discussions with clients. People spend decades building wealth inside super without realising that part of it may eventually be taxed when it moves to the next generation. Now, the important thing to understand here is that super doesn't automatically get treated the same way as other assets when you pass away. If your super goes to a spouse, it's generally tax-free. But if it goes to adult children who are financially independent, part of that balance can be taxable. And this is where it becomes important, because for some families, we're not talking about a small amount. The tax bill can run into tens or even hundreds of thousands of dollars. Now, the reason for this comes down to how super is made up internally. Your super balance generally has two components, a tax-free component and a taxable component. The taxable component is usually the largest part for most people, especially if most of your balance came from employer contributions, salary sacrifice, or investment growth over time. And when the taxable component passes to adult children, there can be tax applied to it. Now, to keep this simple, for most people with a standard tax super fund, the effective rate on the taxable component is generally 15% tax plus 2% Medicare levy, so around 17% in total. The Medicare levy is simply an additional 2% applied on top of income tax to help fund the health system. So if someone passes away with, say, $1 million of taxable super, that could potentially mean around $170,000 lost to tax. Now, in some situations, particularly where the benefit includes an insurance component, the member passed away before age 65. An untaxed element can arise which is taxed at a higher rate of 30% plus the Medicare levy. But for most people approaching or in retirement, the standard 17% rate on taxed element is what typically applies. And this catches people off guard, because they often think, I already paid tax while I was building this, or super is supposed to be tax-free after 60. And during your lifetime, in pension phase, that's often true, but death benefits to adult children are a separate issue entirely. Now, this doesn't mean everyone should panic or immediately pull all their money out of super, because super is still an incredibly tax-effective structure during retirement. But here's what most people miss. Sometimes the structure that works best during your lifetime isn't automatically the best structure for intergenerational wealth transfer. And that's where strategy comes into this. One of the most common approaches used to reduce this future tax bill is gradually increasing the tax-free component of super over time. One strategy sometimes used for this is withdrawing money from super and then recontributing it back in as a non-concessional contribution. This generally applies once you've met a condition of release and can legitimately access your super, so it's not something that can be done at any age. Because when you contribute money back into super using after-tax money, that amount generally forms part of the tax-free component. So over time, in the right situation, you may be able to reduce the proportion of your super that could eventually be taxable to your children. And this links closely to the nomination and estate planning side. I've covered that in detail in another video, which I'll link below if you want to go deeper on that one. Now, this is where advice becomes really important, because there are contribution limits, age-based rules, total super balance thresholds, and estate planning considerations sitting underneath all of this. So this isn't something you want to implement blindly, but conceptually, that's the strategy people are usually referring to when they talk about reducing super death tax. And to be clear here, this isn't about avoiding tax in some aggressive way. It's about understanding the rules properly and structuring things intentionally while you still have options. Because once someone passes away, there's often very little flexibility left. The planning opportunity usually exists before that point, not after it. And this is why these conversations matter. Not because people love talking about estate planning, but because small decisions made earlier can materially change what the next generation actually receives. Now, another thing worth thinking about broadly is whether all your wealth even needs to stay inside super later in retirement. And the recontribution strategy is just one approach. More broadly, it's worth asking whether drawing down more, assisting children earlier, or structuring assets differently over time makes sense for your situation. Because what often happens is people become extremely focused on minimising tax during their lifetime, without thinking enough about what happens afterwards. And sometimes a strategy that saves a small amount of tax today can create a much larger tax bill later for the next generation. So if you're approaching retirement or already retired, this is one of those areas that's worth reviewing properly, particularly if a large portion of your wealth sits inside superannuation. And importantly, this isn't just about wealthy Australians, because property growth, compulsory super contributions, and long investment timeframes mean many everyday Australians now have substantial super balances later in life. So the questions I'd be thinking through are these. How much of your super is actually taxable? Who is likely to receive it one day? Would they be considered dependents for tax purposes? And have you structured things intentionally? Or has it simply accumulated that way over time? Because what most people want isn't just to build wealth efficiently. They also want more of that wealth ending up with their family rather than unnecessarily lost to tax. This is general in nature, so it's important to consider your own situation, because the right approach depends heavily on your age, structure, contribution capacity, and estate planning goals. But if this is an area you've never reviewed before, it's probably worth understanding now, rather than leaving it until the point where nothing can really be changed. If you want to implement this properly, I help Australians structure this every day. Details are below.